Hi, Assalamualaikum warahmatullahi wabarakatuh. To my lecturer, Sir Farid, Zakaria, to my fellow classmates and to all of my fellow friends. My name is Nur Iniza Syahira Muhammad Suhaimi from class GBA 1145C, and today I'm going to present the subject Analysis and Valuation of Fixed Income Security, or well known as FIN 367, in the topic of Introduction of Bonds, which is the first topic in this subject. In this subject, I will be briefly explain three types of main topic in this topic, which is the first one is bond risk. In bond risk, I will show you the slide in interest rate risk, credit risk, inflation risk, reinvestment risk, and liquidity risk. The second subtopic, which is bond ratings and risk, I will be showing the slide on bond ratings, bond rating agency, the meaning, the introduction, the criteria used by a certain agency to value the bond, and the importance of ratings. And the third subtopic, which is the bond yield and values, I will present the slide of reason of price fluctuation, changes in interest rate and bond prices behavior, and yield curve, the type of yield curve, every single function, every single introduction of the yield curve, and last, the factors affecting the cost of bonds in this topic. So that's all. Thank you. Okay, the first one is, what is bond? Bond is a long-term fixed income security in which the issuer or the borrower has agreed to pay fixed amount income payment for a specified maturity and to repay a fixed amount of principal at the maturity to the bond holder or the lender. There are three parties involved in bonds, which is first one, issuer, second one is the financial intermediaries, and the third one is holder. Okay, the first one, issuer, is the one who issued the bond, which is government and their agency, corporation, commercial banks, foreign institutions, and financial intermediaries involved in primary dealers and investment banks, and the holder, the one who hold the bond or have the bond, is government, pension funds, insurance companies, mutual funds, commercial banks, foreign institution, and household. Okay, the second one is issuer and holder. Issuer is either government or a corporation for borrowing purpose for a specified amount of money for investor at a specified period, and the holders is a corporation. For example, like financial institution normally invest in bonds, and individual investors do not normally participate in bonds, are usually sold over the counter in large amount. Buying and selling are a common terms in bonds, which is buying, we buy the bonds, which we can buy in two market, which is primary market and secondary market. Primary market is when the issuer first offer the bond to the issuee for first time, and secondary market is when the first buyer sell the bond, and the bond that have been sell again to another bond investor. That is a secondary market, and selling bond is in the involved in the secondary market. Basic structure of bonds is, the first one is par value. Par value is used for calculation if the issuer is the calculation of interest payment, and par value is a fixed par value, which is 1,000, is the money amount the bond will be worth at maturity. And second one is interest payment. Interest payment is a coupon rate a coupon rate of the interest the bond issuer will be paid on the face value of the money of the bonds expressed as percentage. Maturity date is when the bond itself has achieved the maturity date of the bond, and which is the investor has to pay the price at a maturity date, and that is a very specified date, which is they have three: short term, medium term, and long term. The short term basically mature within the 1 or 3 years of the bond. Medium term bonds is normally over 10 years, and long term bonds normally a longer period of time. Next is bond price and yield. Bond price is the bond price itself. Bond price is in face value, premium, and discount. And yield is the return of investment of that bond, and the relationship between price and yield. When price increase, yield automatically decrease, and when yield is increased, bond price will decrease. There are many types of bond, and I'm going to briefly tell nine types of bond, which is the first one is government bonds, second one is trade bonds, third one is floating bonds, fourth one is trade bonds, fifth one is junk bonds, the next is Islamic bonds, next is convertible bonds, and next is mortgage bond, and lastly is guarantee bonds. The next type of bond is international bonds, which have three, which is the first one is Euro bonds, the second one is Yankee bonds, and the third one is international domestic bonds. Advantages and disadvantages of issuing. The advantages of issuing is the first one is obligation is limited to fixed interest payment. The second one is cheaper than issuing shares. Third one is interest consists tax deductible, and lastly is it does not affect the shareholdings. The disadvantages of issuing, which is the first one, debt level increase equal to risk increase equal to increase in cost capital. Interest payment are mandatory, and the last one is paying interest will reduce firm profit. Last and but not least is advantages and disadvantages of investing. Advantages of investing is lesser risk than equity capital. Bondholder equal to security creditors, can be traded even before maturity, and the last one is predictable stream of income and guarantee repayment of principal. The disadvantages of investing is long-term bond equal to volatile and sometimes fail to keep up with the inflation. Second one is no benefits such as shareholders. The third one is call risk, and lastly is bond rates lower than dividend rates.